Welcome, everybody, to another episode of the System 2 podcast. Today, I have the pleasure of having Kirk on. Kirk's been a friend for a while. You have a long history in the hedge fund space. But before we get to that, I'm wondering what is one thing that's broken about the way hedge funds buy data today?
One thing there's a lot of friction in the system. I think fundamentally, there are a number of different frictions that we're seeing in the world. One is if you think about everything from trialing and sampling and the length of the sales cycle, that's something that is a challenge and broken and not coincident across the space. There's also the challenge of evaluating what the data sets are valuable for relative to price and how to think about the valuation of an underlying data asset and how it's going to help their business. And then the last thing I would sort of bring up, and we could talk about this the entire time, the power of transaction data sets as being sort of quasi reference for building ontologies and taxonomies for your data structure internally, i.e., a receipt panel has millions and millions of SKUs and brands and products that you can then turn into part of your overall ontology structure as you're thinking about building out a broader data asset inside the firm. So I think there's a lot of practical application to data that isn't really going all the way through into the overall evaluation and build.
How do you think about the valuation side of it?
So the way I think about the valuation side of it, it's going to differ depending on the end use case of the data and how a firm trades and monetizes. For folks that trade anywhere between, sort of call it 15 days to 6 months, it really is about, sort of an at bats and hit rate ratio. So take a big step back. If you think about any business, any hedge fund that's not using any data at all, just pure valuation, fundamental work, traditional discretionary decision making, they're going to have a hit rate on their portfolio. It's going to be normal, right? That hit rate could be anywhere between, sort of 55 and 80%, depending on sort of where they live and the sort of the frequency of trading stack. The data information that somebody would buy has to contribute to either creating more at bats, having a higher hit rate on those at bats, or improving the size of their bets. That's where you get your lift. If you have a hit rate of 55 and it goes to 57, if you usually have 100 at bats and you take 115, or if you sort of usually do $1 million bets and you go to 1.5 million on the things that you have higher conviction in because of your underlying data, that's where you start to create a lift framework. You should get hard ROI against your lift. So the way it prices should be around the number of informed tickers, the number of informed at bats, the number of those at bats that work. And doing that consistently over time, you can get to a place where you can start to sort of build almost like an alpha cash flow framework that allows for you to sort of back into what the appropriate valuation is. But historically, because data has aggregated into discrete asset pools, credit card, clickstream, geo, and app being four of the big ones, there's been sort of pricing mismatches relative to alpha generation and alpha creation for these assets because of the way data has grown up on Wall Street.
And on that point, like you guys at Carbon Arc have done an interesting take on pricing, packaging, selling data. Tell me more about that.
Yeah. So, you know, buying data on the street, sort of in the early days of, sort of understanding and seeing the market structure for data, right? Um, Credit card data in 2013 was a real differentiator, and having access to that data was a differentiator. Today, it's table stakes, right? It's something that if you're trading consumer, if you don't have access to credit card data, it's a massive disadvantage, right? Because you don't even know what your peers are trading against, right? So there's been huge changes over the last, 10, 12, 15 years. And looking at the, like we talked about earlier in the conversation, the frictions that exist around data structure are manifold. First of all, it's usability. You guys, are here every day, helping people make better sense of data, right? That is your specialists. You hire really sharp people, and you sort of help your clients make sense of data and build better data products to help them generate alpha. But that's a hard work, and it's, sort of requires special skills. There's licensing. There are terms of use and, sort of a licensing contract that creates time. And also sort of there are licenses that you won't do. There's compliance. How does somebody collect the data? Where does the data exist? And then the last thing is pricing. If there are only a few players that are in the market, there's a pricing construct that can be, sort of onerous. When you put all those frictions together, data doesn't really trade. It's really expensive. It's really hard to work with. And, the lead times and sales cycles are really long. That forces data providers to keep their prices artificially high. And it forces data consumers to sort of really have to make big decisions on very few assets that crowds out all of their spending on everything else. And so fundamentally, you now live in a world where if you're a fund and you want to spend $3 to $5 million on data, you can chew that up with 3 or 4 data sets if you're doing rollout. And like that only covers about 100 tickers. So you've got this over index and skew to the whole thing. And our whole view and why we started Carbon Arc was for all the data that exists in the world, very little it makes the hands of decision makers. Supply and demand are too far apart, and the ability to pay and willingness to pay are the biggest drivers of data liquidity. And so we have this view that if you could smash down the cost of insight, break the licensing construct, pay providers on what gets consumed, and give consumers the opportunity to create the data structure they need to drive a hard ROI on their data buys, you could actually drive more consumption, more diversity across the different inputs that people are consuming to drive better outcomes in their research, and start to develop a consumption-based framework and a markets-based approach to insight generation, right? And so, that all comes from this idea that when you take a credit card panel or you take a closing panel, pick your panel, healthcare claims, you're basically doing a ton of work to clean, normalize, tag, and dedupe to generate an aggregation that's going to help you and help inform some outcome. So fundamentally, that aggregation has time decay. It's eventually right or wrong. It's got volatility. It's either right or wrong. And it's got a cash flow associated with it. Those are the 3 things you need to price an option. So fundamentally, you're writing tickets. It's a derivatives
Yeah.
business. So if you're running a derivatives business, you can take a markets-based approach to the underlying. And so that was the impetus and the driver around the idea, which is like, sort of, my career was always underpinned by research that was done by having a high end of collection. I never talked to one person and said, this is what's happening. It was always an amalgamation of weaker signals. I'd rather 5 weak signals than one strong one over time, right? And I always had this view that, sort of I was able to do that because I worked at shops that had, really believed in the idea of proprietary research and everything else. So I had the ability to go out and do that at scale, but a lot of firms didn't. And it was a process orientation. And my whole belief was if you could build a portfolio of inputs, you're going to have better outcomes over time. And the only way you can do that is by breaking price.
Yeah. So on that point, like you worked at some big funds and I'm curious like what your data budgets were and how you think about sort of the TAM in terms of the unlock in value you can create by providing additional like liquidity by breaking down these data sets into smaller chunks that would presumably like bring more buyers into the market. Like how do you think about the market size, the TAM? Like how much are big funds spending on data versus how much do you think the rest of the funds should to catch up?
Well, Wall Street, and I'll speak generally. I can't speak too specific about my prior firms just for a bunch of reasons. Sort of I think about it first to start in sort of 2 ways, right? And there's like almost like a today and then in the future conversation, which is actually an interesting one because of we have to start talking about what we think agents are going to look like over the next 2 to 5 years. But just to start, sort of um, you can back into, I think, with sort of pretty pretty good, pretty decent precision, just looking at card, click, app, and geo, have a handle on swagging what the revenues are of the big guys to get to sort of the data spend in financial services. If you look at sort of card and it's sort of the big guys is probably like a couple $100 million of business total, depending on how you cut financial services. App was probably another 100. Clickstream is probably, I mean, you can see SimilarWeb, it's public, and I'll sort of call it another sort of, it's probably just on those big four, 500 million bucks. So we're not talking market data. We're talking sort of like what people call traditionally alternative data. I think what's interesting, my whole belief was there were probably 500 qualified buyers for what I would call data capex over 2 million bucks on Earth. Right? And that includes big tech, and that includes your large hedge funds and your financial services firms. Sort of, but my whole belief is that you can actually increase the TAM from 500 qualified buyers to 500,000. Now, those 500,000, some of them might be doing 500 $1,000 buys, but I'd rather 500,000 at $1,000
Yeah.
than 500 at a million, right? It's better business, better market, it's healthier, you know? And so what I think is interesting is you actually don't grow the TAM necessarily. There's just a redistribution of wallet
Hmm.
across Wall Street. And that assumes no change with agents and workflows, because what happens if agents proliferate, the capital it's usually being paid to, if you don't see the analyst pool grow, but it stays stable, that's one thing. But if it actually goes down, some of that gets reinvested in data structure. That's what I think happens, right?
Hmm.
If because it depends on sort of what your view is around sort of like the growth rate or replacement rate of analysts, which brings another question in, which is how are people going to get trained? I actually think one of the biggest challenges and one of the scariest things about the proliferation of AI is training young people on how to model.
Okay. Say more. Yeah.
Well, think about it, right? Like, you sort of like your first 2 years at a bank in a banking organization, if you're a junior consultant, if you're a junior analyst going through an academy at one of the large hedge funds, you spend a lot of time in Excel learning how to build a 3-page model, cash flow, balance sheet, and that happens in 9 seconds with 15 different plugins right now.
Yeah.
And the model works, and the model's clean, and the model's laid out, and it's, sort of my concern is how are people going to think about the apprenticeship of Wall Street? Like Wall Street
Yeah.
is a block and tackle business, and it is a time and seat business, and it always has been. And being smart isn't enough. There are a lot of smart people that don't make money in markets, So it's really a combination of grit and experience and understanding and domain expertise and knowledge. It's a complex system dynamic, but one of the core, you need to understand how to build a 3-page model. Now, math has changed over the years. And if you look at when the calculator came out, people were saying the same thing I'm saying. So, like, I definitely sort of am mindful that, at my ripe old age of 49, I could be just spouting old person sort of language around AI. But, sort of, I do worry about the training that comes from the late nights and the hard work and all the things. The belief that people can just step in and have ownership over something just because they've seen it for 15 minutes. I do think there's a scuba diving versus surfing component to this sort of movement that I'm a little concerned about, because I do think you have to put in your time and pay your dues a little bit.
And yeah, these programs have historically been feeders into, like, yeah, start off on the sell side, and then some percentage of those folks end up on the buy side. Some percentage of those keep rising through the ranks, and at least on the fundamental side of it, that's how you end up making these, famous investors that have risen through the ranks and been selected over and over again. But if that initial pool of talent gets dwindled, or they're just not that good, like, do you think that's going to impact the types of analysts, people that hedge funds can hire, at least in the short to medium term?
I think it could. I think people have to be thoughtful. I do think there's going to be a reallocation of folks inside of funds. If you sort of take a big step back and you look at on the discretionary side, let's leave quant to the side for a second, because I think it's a different thing. But if you look at the discretionary side and you look at fundamental research, the old way back in the early 2000s was 2 and 2. So one of the reasons when I broke in on Wall Street in 2005, I didn't have banking in my background, and that was a huge headwind for me. I ended up claiming a seat. I got to Glenview, but it was a knife fight. It was really hard. You know what I mean? And it wasn't a traditional background at that point.
How, yeah, say more about that, especially for the younger people like listening to this. Like, what was your, so I don't know, you went to Harvard, so that helps to start off, but like what was the, oh
Yeah.
yeah.
So the background is, I was Harvard 2000, and my junior year, 1999, I interned at Tutor and worked in the venture group. And my job was to establish the cold calling program for deal sourcing, like Summit Partners or TA Associates. East Coast VC is very much cold calling, and West Coast VC is very much, sort of invest in, sort of like the community and the network, right? But East Coast was a lot of cold calling. I cold called my junior summer. I cold called companies like Google. It was
Huh,
1999. You
no
know what I
way.
mean? Oh yeah, yeah.
How'd that go?
They didn't call back.
Yeah.
Larry and Sergey didn't call.
Yes,
Still
no way.
waiting.
Yeah.
Yeah, at some point.
Well,
Um, and then I converted that into a full-time job after graduation. Landed there in June of 2000. March 2000, market crashed, and I was there for 3 years. And then I went back to MIT for business school. So I'm in business school. It's my second year of business school. I'm driving down to New York because I want to live in New York. I want to work on Wall Street. I want to work at a hedge fund, and I'm interviewing all over Wall Street, and I'm getting killed in interviews. Shaved head, no banking experience, thick Boston accent, way thicker than right? And I'm getting killed in interviews. I go on an interview on a Friday afternoon. I'm supposed to meet with the guy, but I'm getting a lot of looks
yeah.
because I worked at Tudor, and Paul Tudor Jones was a well-known dude. I didn't obviously work with Paul. I worked in his organization, but like that name got me interviews. I got,
Quick timeout. Why'd you have a shaved head? What was the look
oh God,
for?
I started shaving my head in January, February of 2004. I went to Tokyo. It was my first trip out of the country. Didn't get a passport till I was like 26 years old. I was a Boston guy.
What else do you want to see of the world when Boston's like
Yeah,
plenty?
yeah.
Yeah,
I mean,
it's
it's
the
it's
best
it's like
of, yeah.
it's the beginning and end. I ended up in Tokyo, and I was really struck by the elegant simplicity of the culture. And I came back and I shaved my head, and I never grew back.
Oh wow.
Yeah, yeah. This is as long as it gets. So I go into this interview. It's like April of 2005, and I'm trying to get a job after graduation. And the guy I'm supposed to meet with, he goes, "You're going to meet the team." I'm taking off. I thought I was having a cup of coffee. So I go into this like team interview. It's like 8 guys. And I get to the last guy, and the last guy is a pretty well known dude on the street. And he looks at me after like 5 minutes. He goes, "You're never going to work on Wall Street."
Wow.
Yeah, it was awful. And I walk
What
out.
would you say to that? Yeah.
I took it,
Yeah.
and I got up and I walked out, and I was like, okay. And I was going into an interview the next week, and I had to pitch Sears and Kmart. They had just merged. And I locked myself at the computer lab at MIT, and I cold called hundreds of people around the name. And I got the head of supply chain for Scotts Miracle-Gro and Whirlpool, the head of Procter and Gamble supply chain on the phone, and I talked to them about their expectations for a merger like that and what the improvement could be for inventory management. And I based my entire model around those calls, and I got a synergy number of 1.5 billion instead of the 500 million that had been published. And I brought it into the interview the next week, and I got called back. And then I did another project, and I got called back again.
Oh.
And then they offered me an unpaid internship, and I was like, guys, I got to make some money. And so I called Jimmy Pilata, who ran Tudor Boston, and I told him about the project and everything else. And he said, call Larry Robbins and give David Windreich a call. Right. So I called Larry and Wendy ran Oxif, and Larry ran Glenview. And I got the final rounds of both those shops. I didn't get a
But
job.
did you call those head guys directly or just
I
call the
emailed them.
funds? Yeah.
Processes at both.
Well, so you like, what was that email like? Was it like a warm intro from somebody else, or was it just cold email saying like, "Hey, I got this project"?
It was either, I can't remember, to be honest with you. It was either Jimmy emailed Larry and CC'd me, or I emailed um, Larry and put Jimmy Pilata's name in the subject
And
line. And I met Larry and I met Wendy, David Winreich, and got the final rounds of both those places. Didn't convert. Ended up working at Hunter Global. I was at Hunter Global for about 6 months, but I got a call from Larry over at Glenview. I had seen him out, and they were starting an office in London, and so I got an offer. I got an offer to go over to Glenview to help open the London office as the junior guy,
wow.
and I jumped over there, and it was an unbelievable experience and a great group of people, and I learned it. So
And
I,
so hang on. This stuff is like really fascinating because it sounds like you've, in a lot of these situations, like created your own luck and opportunities. So when you say you were at Hunter, but then you had seen the Glenview guys like over coffee, like you were still in touch with them. Like what were you doing?
I ended up going to like a mini idea dinner that Larry was at, and I had done a ton of work, and we ended up comparing notes on Home Depot. So I ended up, I think how, in hindsight, it was like an interview process. I had
Yeah.
done a ton of work and everything else, and ended up going over to Glenview and landed there January 2nd or 3rd, 2006.
Wow. And yeah, and a lot of another theme that comes up is like, so you're taking the initiative on doing a project, even though it wasn't something that they asked you to do.
Oh,
Like
I
you
was,
were like,
yeah, it was an idea dinner. So it was one of the ideas I had been my current seat. So when I went to Hunter, I took over career education and for-profit education. So I was doing a ton of work in for-profit back in '06, which was like it was a
wow,
war zone. All the tiger cubs were along it. There was a short keiretsu around it because, obviously they were all going to blow up and they did. But like there was a very big bull bear case because there were great growers, cheap on growth, so garpy as hell. And then on the other side, they had government financing and financial fraud and all this stuff that you love. It was
uh,
awesome. It was fun. So I spent a lot of time on it. I mean, I worked 90 hours a week from 2005 to 2016.
wow.
Oh yeah, I worked all the time.
And how did you get that initial idea to do channel checks or to cold call people?
It was literally just like I did it on that, like I had done it on deal sourcing, and I was really good on the phone, and I was really good at crafting emails that could get people to come back to me.
Hmm.
So I was just really good at connecting. I was a connector guy. And then the call stuff started to pick up because like when I went to Glenview, um, Harry started giving me projects on other people's names, even though I was an analyst covering names, right? And I was green and coming up the curve, but he'd give me projects, and like I started having some success with that. And then he said, you know what, this is what you're good at. You should do this. And so like I'd love to take all the credit at all the times. I'm certainly not afraid to do that, but like, um, Larry was like an incredible mentor and friend, and also like really understood competitive advantage. And he was like, "You have a competitive advantage here. Like, let's build that out." He gave me the mandate and the opportunity to build out the largest primary research business on the street at Glenview.
Wow.
By the time 2009 came around, we were doing over 10,000 calls and change in 100 supply
Wow.
chains globally.
Like a year?
Oh yeah.
Yeah.
Oh yeah. We were the largest consumer of expert networks, man. And we did it the right way. We had the right approach to compliance. Mark Horowitz was the GC. I think he's the president of the firm now, or co-president or whatever. Great, great dude. John Roden was my boss, director of research. They were all sort of huge proponents of good, high quality work, and like we built something really cool.
So how old were you when you were given that mandate?
It was 2007. I was 30.
Okay. And so yeah, and what was that like? So you're like you go in thinking you're gonna be an analyst, but then Larry tells you like you're really good at building out
It
something
was
bigger.
it's what's funny is it was really hard. I mean, like it was like the probably the best thing happening in my career. But at the time, I was really bummed because I wanted to be a quarterback. Like analysts and PMs are quarterbacks. You know what I mean? Like they're the prom king, and and they kill it. And like and then sort of it was Roden. I think they gave me The Blind Side, which had just come out, Michael Lewis's book, and the entire book is about this kid coming up and how left tackle's the highest paid players in the field because of what Lawrence Taylor did to revolutionize the defensive end position. And I read it and I was like, okay, if I'm going to be a left tackle, I'm going to be the best left tackle in the game. And so I really studied how my competitors were competing on expert calls. And I literally sort of transformed how that worked. I applied portfolio theory to building channel checks. to diversify away risk.
Mm.
Um, instead of doing quarterly checks, did the monthly, manage the compliance framework and all the other things. And that became like frankly, the foundation of my entire career. I did that with Larry until I left in the middle of 2012. And then I went and built that for Steve. It's called Canvas. And, started there December 31st, 2012. Built that from like 13 to 15. So yeah, so I oversaw my career, God, hundreds of thousands of calls.
Wow. How many of those calls were you personally on, or like, what was your involvement later on in terms of like
I mean, I probably did, just if you look at, I could actually, '07 was probably, I probably did 12 to 1500 calls. '08, I probably did 1500 to 1800 calls. '09, I did 2000 calls.
wow.
10, I probably did 2000 calls. 11, I probably did 2000 calls. I ripped about 1500 to 2000 calls a year until probably 14, and then sort of started to move back into management, and then, ran the thing. Um,
What did you learn from doing all those calls? I mean, you've spoken to a lot of people,
well,
more than like most, yeah,
so,
people
so
on.
like, this is part of the fun stuff because like when you do enough of anything, you start to optimize around certain things and create certain hacks, right? And so like everything from sort of the way I think about decision tree frameworks and tracking change in decision trees. There's like advanced math theory in there. I've shown some of the stuff that, like, I'm sure if we sat down with some of the scientists and laid out what it looked like, they'd be like, "Oh, that's that, that's that." I've had people do that to me, which is kind of cool. But what I've learned is like, um,
Like, what's an example? What are some of these decision trees?
well, if you start to look at sort of like, so one of the frameworks that we developed, sort of over the years and doing these calls is that like you're trying to track change of expectations. It's actually not absolute change. Track absolute change. Like absolute change is very volatile depending on who you're talking to. You have to be really, really careful around saying if something's up 10 or down 10 or versus what. Last year, last quarter, last month, you have to collect a lot of information to have
Mm.
context around a thing, right? But like expectations are usually driven through a value chain by the biggest player in the chain. So you just need to manage against expectations. And once you manage against expectations, if something's better than expectations once, expectations get reset. So it's really hard to be better than expectations twice. So then you
Huh.
start thinking about like T1, T2, T3, and then you start looking at sort of like, sort of an understanding of like, and then you start getting into pruning. Well, if it's better, then the next time it's either going to be in line or worse. Can't be better again. So you very rarely talk to somebody who's better 3 times over,
Yeah.
right? So all of a sudden you went from a tripartite outcome, better, same, worse, into a binary outcome, same, worse. And then it's just probabilities, right? So like some of that is like the self-correcting expectation tree, right? The other thing is everybody lies,
Okay.
not on purpose,
Yeah.
but everybody has a context. So the way you can play with that context and understand that context is really start to tie it out to their personal experience and when the last time they saw something was. When was the last time you saw this? What happened? What happened next? You know, I learned that putting stuff into the market that wasn't true just to test is actually a really useful tool. So sometimes you just say, "Hey, I'm hearing cuts. Are you seeing that?"
Yeah.
Just to test their validity because it's a conviction level framework.
What were you expecting to like? What are you testing with asking like planting some of this stuff?
You're testing their veracity sometimes because credibility matters. It's what people can see from their seat and credibility, right? So like it's like, okay, do they have a vantage point? And then are they telling the truth,
Yeah.
right?
Okay.
Because like there's one thing, somebody might not be seeing something, but they might not be able to see it.
Yeah.
Like, just because somebody can't see the sunrise doesn't mean the sun didn't rise. If they can't see it from where they're standing, the sun still rose. They're just not seeing it, right? So it's
Yeah.
just like figuring out where they fit in the horizon. I learned that, sort of more calls are better than less. I learned that for me, the best way I could do it was collect one anecdote from 20 people, not a full script from 20 people. I would just collect stories and I would collect touch points and scale points and different things. I learned that you could decompose companies into market structures, business models, management teams, and near-term KPIs. And the thing that matters the most is if the market structure and business model are intact.
Okay. How do you know if they're not? What were some of the giveaways?
You would hear about new entrants. You would hear about sort of changing dynamics around pricing that are structural. Sort of you would hear about, sort of unexplained changes in the supply chain that they couldn't understand, that wasn't macro related. Like most stuff is macro related. At the end of the day, most stuff is sort of like went through a bunch of different cycles. I was doing channel checks and supply chain work during the housing crisis, during the financial crisis, during the rise of the iPhone, during the oil shock in 2014, during COVID. I saw a lot of really interesting and dynamic supply chain disruptions. Um, sort of, but like you could start to see looking for new entrants. Like, so on the short side, we did a lot of work on monopoly to commodity. So like what you learn are that too with the market structure business model, there's stories. So Tate and Lyle goes from, it's the only sucralose producer, and then it's not. It trades like that looks like a biotech. You
Mm.
know what I mean? Airbnb goes into hotel reservations and jams, and that's the reason you want to catch those in new entrants before they happen is because it hits the multiple before it hits the fundamentals. You won't see it impact Airbnb. You won't see Airbnb in that frame impact Expedia or Booking when like the announcement is enough to hit the stocks. Right. So that's one where the entrance is actually more important than the fundamental outcome because it never actually showed up in the P&Ls.
Yeah.
Right. But the market structure changed. It went from a
Huh.
duopoly to an oligopoly, which changes the pricing construct. And so the key is, and the reason that's really interesting is this is where I started to figure out how to get scale in checks. Is hotels and hospitals are the same business,
Okay.
right? They both care about length of stay.
Yeah.
The end markets are different. The reasons they exist are different. TSMC and American US Steel are the same thing. They just have different end markets, right?
Huh.
So like you could start to get that the fixed cost and variable cost framework is the same. Sort of, if you want to understand what's going on at John Deere, talk to steel service centers in the towns that sit next to the combine factories. You don't even have to ask them specifically about John Deere. You just have to ask them what's going on with their business. Better, same, worse. How are your inventories? Are you busy? Like you want to understand because like 45% of John, or at least I'm dated on the number, but 45% of their profits are from combines. So guess what? If combines are working out, John Deere's gonna be fine. If John Deere's gonna be fine and combines are gonna be fine, the guys selling steel likely in the facilities because they're not. If the steel service center is in Moline, they're not buying steel from Boston.
They should, but
The steel's better in
yeah,
Boston,
right. Yeah.
usually, because
Yeah.
everything is the Red Sox to the Yankees,
Yeah.
the Red Sox Yankees dynamic. But yeah, so like you can learn a lot about scaling work. How do you sort of create frameworks that allow for you to sort of have translation? And one of the reasons that we had to do it is because like at the end of the day, you're hiring 23 to 25-year-olds to get on the phone. They need to have a nomenclature and a lingua franca that allows for them to talk to each other, to talk to you, to have credibility, veracity, and believability with the people who are consuming the product, who are, really voracious and discerning research consumers.
Yeah.
You know what I mean? Like you can't mess around. Stuff's got to be right, and it's got to be accurate. It's got to be thoughtful. It's got to be compliant. You know what I mean? And so like that's all training that has to happen around this sort of ethos.
How did you end up doing the recruiting of the folks you're speaking with and building out that network? And there are obviously companies like GLG and others that can help with that. Were you guys doing
We
some of
built
your
our own
own?
network.
You did
Yeah,
your own. Yeah.
we built our own network a couple times, and that was just brute force. We're doing work in roofing. Send a million emails in roofing. We're doing work in rare earths. Send
Yeah.
emails to everybody. Hit association newsletters. Hit like old fashioned, like Google plus asterisk @ sign, all of the things. We'd look for lists, we'd pull those lists, we'd rip them, just build the network that way, and it was just like, it was funny. It was extremely low tech and we just pounded it.
How do you think AI is changing this?
Look, I mean, I think AI is changing it in a number of different ways. It'll be interesting to see what's good about it and what's not, right? Because they're certainly increasing noise. I just don't know how much they're increasing AI agents are doing call. That's out there. And you're
Yeah.
seeing a number of different transcript library guys, as well as you have heard of and know of folks in the hedge fund space that are using agents to scale their calls businesses. I do think there's obvious value in that on what I would call lower end or lower value calls, because not all calls are created equal. I do have concerns about it on the high end.
Do you feel like, given even what we were just talking about, some of the lessons learned from making thousands of calls per year, that you'd be in a good position to like program some of these agents to make better calls? Do you, I mean, or maybe said differently, like to that point about if it's out of some random analyst at a hedge fund that's trying to use an agent, but they don't know how to work with those agents to get them to do this at scale. Is there value in having people that have done this for a long time to use some of that training data to make better agents?
I absolutely think so. I think the thing that is most interesting in sort of the thing I'd be checking against the agents is quality is in the eye of the beholder. And I haven't seen sort of full disclosure, a lot of content out of the agents to speak of. We're not running them at Carbonark, so like I don't have a ton of visibility into the output. I think the output is going to be what the input is, right? And like, look, um, I think it's all about how you program it. And the thing that I think gets hard is there is a check and balance on quality. And like, I know from experience that, sort of there was a lot of work that went into understanding nuance on calls, listening for the change of, like a hair, month over. I think for bigger projects, like people winning or losing share, that it's just more like a collection mechanism. Like there's a ton of value in it. But like for the stuff that requires nuance or rate of change understanding and asking the question behind the question behind the question on with somebody, I don't have a good handle yet on how that's going to work with the emotional connection between, sort of a human and a robot when the robot's asking questions, whether the robot's going to pick up on the nuance.
Yeah.
Do you know what I mean? That's where I think, and by the way, that's the difference. That's where alpha resides. Domain expertise gets you to the table and creates alpha in the gray, on a black, gray, yellow, not on a like a compliance gray. But like that nuance around rate of change and understanding rate of change and all of that, that's where the rubber hits the road on a lot of this stuff. And I do worry that with the amount of like, it's just like, when like you see someone who's doing the work on the data and they want 9 decimal places because they get really comfortable in the
Uh,
precision, but it's fucking made up. Right? There's something about like we can do more calls. There's an efficient frontier on the number of calls. Then you're just creating noise, right? There's like it's almost like there's like a diminishing rate of return on signal the more calls you do. So it's kind of like what's the right? Because then you start just getting a mishmash of stuff. That's the concern.
no.
You can have too many calls. And so that'd be the thing I'd be focused on is, and by the way, the other thing again, to go back to the conversation earlier, think about all the stuff that I just like spouted about like deer and everybody else. It's not so much knowing Moline and combine fat facility, which is a fact. It's understanding the context layer of the steel service center that sells in that market is likely going to have their business is likely going to be very tied to whether or not, sort of the facility is doing well, or at least that's an inference that we can make, right? And like that's a learning that just came from gutting it out. And
Yeah.
like you worry that like when you start layering everything with like sort of an agent layer, does that all get translated up?
Yeah. Yeah. No, I think it's I was just talking to a friend who's been working on these graphs of connecting different investment concepts to be able to identify second, third order effects of something. And now like he's been working on this for a while, but now you can leverage these LMs to like populate some of these graphs to try to get at some of these impacts of concepts that you might not otherwise think of. But it's yeah, it requires a decent amount of thought and structure. You can't just
You're
take it off the shelf.
subject, and until you have sort of like completeness of data, you're going to have imbalances in that graph, right? It's a tricky build because like, by the way, like we're not building sort of a graph of concepts in the same way. Our graph is more around an entity plus an event equals an outcome, right? So like Bad Bunny Super Bowl would be an entity and event, right? So it's an organizational world model framework, right? With a system of record that's transaction based, right? Because the transaction, that system of record, whether it's a card swipe or a click stream or an app engagement, those are all, sort of records of a transaction. Transaction being time or money. We view those as like actual decisions that Matee or Kirk are making. And so like that's actually a good record because that actually is something you decided to do.
Hmm.
You took an action, right? Intent is hard. Like you intended to do something or you
I intend to do many things.
right,
I don't do most of them.
right.
Yeah, yeah,
And so that's so we basically built this world model framework that is like composable. So you can pick an entity and pick an event or pick an entity in a framework of time and space, but we're using that system of record to inform it, right? And even that, as we're building it, I'm like, God, we need more of this. We need more of that. I wish I had this in terms of data. And I'm just like, it's a never ending build because most of the data is sitting on balance and most of it's not on the web. Everything that's on the web is already been structured and is now, frankly, getting really sloppy. There's an API company starting every day sitting in front of the same data sets. It's
yeah.
like this really interesting thing. And so it's fascinating. Like what your friend's trying to do is a hard problem. It's a valuable problem. And I think a lot of the different firms on the street have to be trying to figure it out. But even
Yeah.
there, like, the street's got, sort of a lot a lot of how people are going to do in the next wave depends on how their data structure is today, their data hygiene.
So on that point, like we we were just having a conversation this morning that I'm getting pretty bullish on, and I'm curious to get your thoughts on this. Like, there's in terms of like this qualitative data of conversations with people. We were yeah just with a firm, and they've been transcribing a lot of their
Sure.
calls. So you can envision now that you have like transcripts from every like biggest sales team that's selling into like Fortune 500 companies, and now I get like 100,000 calls that I can look through for all sorts of signals. Or if you're I don't know, anyone that deals with people or services like recruiting firms, all sorts of like event companies, conferences, like anything that has these stations that are happening and they're collecting it as part of their day-to-day operation. They've been doing it forever. They just haven't been recording it. And now you can like transcribe it and you can put AI on top of it to search through it. I think there are some like compliance issues with that because you don't have compliance up front. You do have to like potentially do it on the back end. But I'm curious if you think that is, I don't know, like, could that be an interesting source of
So
alpha?
full case on the transcript libraries, for example. So Mosaic did a nice job, and I wasn't buyer of the transcript libraries when it started. More about the compliance side of it, like internalizing other people's compliance than anything else. Turned out I was wrong, right? And those have become big businesses, and they've done a really nice job. Third Bridge has done a good job with it. Guide Point, like all of the big guys have Gerson, they've all figured out how to do it, and they're plugging into the Hebbias and the Rogos and all the sort of the agents in a box for banking or private equity or sort of to do. I think there's a ton of value in the transcripts. I think there's great training value about how stuff has worked historically, so long as it was collected well and the compliance is tight. Like let's just put
Yeah.
those to the right side.
I think this is like beyond that, right? These aren't just expert interviews. This is like
No,
like
it's just an
any,
example. Any type of transcript. Like, I'm seeing de-identified doctor transcripts in my own business that we're
that's
looking
interesting.
at. Is
Hmm.
we just got a conversational AI company just reached out to monetize their transcript library that they own. So we're
Yeah.
seeing those opportunities come in, and I see a market for it. So I'm going to bring it in and internalize it. It's a different data structure than traditional credit card or clickstream data.
Yeah.
We're transaction specialists, right? Like we've done a lot of unstructured work, and we're going to be able to pull that in because we do pull that in. But I think there's a big market for it, and I think that so long, like the thing that gets hard is like when it's an agent talking to an agent. Like if you look at like Claudebot and some of this stuff, you start to create real bias in the transcripts because you're internalizing. It's a different kind of bias. So there's human bias, like you and I are talking right now. We're both bringing bias to the conversation. Some of it's how we grew up, where we come from, what our
Like Boston is the best
that's
city.
exactly right.
Yeah. Yeah.
Massive bias.
Massive. Yeah.
Massive. Like it's a different kind of bias if you're internalizing agent to agent what they trained on. So like if you had an agent that trained on Grok's corpus and you had an agent that trained on Claude's corpus, they're going to have different personality types. And that personality types are going to be more finite than I think the world personality types are. Parsing bias gets harder, I think, when it's robotic. At least now. I don't think we figured out how to start to parse that. So there's some of that. So when you have, and by the way, agent to agent on top of agent driven content, you start wrapping into sort of like how do you get to single source of truth? How do you get to ground truth? What is ground truth? How do you source it? I'm getting, I don't mean to get existential, but like it does start to wrap around the axle a little bit. But short answer, I'd be taking as much transcripts as I possibly could take.
You guys heard that? If yeah, if there are companies out there looking to monetize some of their transcript data, we got buyers of it.
Yeah,
It's,
yeah, we make a market.
yeah. To shift gears a little bit, you were an entrepreneur. You've built out these initiatives within some large hedge funds, and 5 years ago, you started Carbon Arc. You
Yeah.
became an entrepreneur. You went off on your own. What's been harder than you thought, and what's been easier than you thought?
Mission, staying on mission and executing the ideals of the mission around democratizing access to insight and generating sort of space for better research and decisioning. Like that hasn't changed. It's been easy. I love the work. What's been really hard is I thought I was hot shit coming out of big funds. I was an entrepreneur to your point, but what I didn't appreciate were the tailwinds. I knew they were there, but I didn't know how big they were. Mandate from the boss. Larry and Steve were unbelievable leaders and managers and mentors to me. And like I had a mandate from those guys to build big things and that was unbelievable. Permanent capital, right? If I was off by $500,000 or $1 million as a budget, like I found it. It wasn't like I had to go find it. It was a different thing. And a captive customer base. At the end of the day, when you're working at large funds, you're always going to have your early adopters. You're going to have your fast followers. You're going to have the great middle, and you're going to have the resistors. But when they all have, like when they all in offices next to you, and you can just walk in and have a conversation, there's this loop and in collision framework that allows for you to scale inside of an organization with far greater ease. Nobody has to talk to me anymore. It
Yeah,
drives me crazy. But those have been sort of, I wouldn't say unexpected, just definitely harder than expected.
yeah.
And like you've gone through
Oh yeah.
the S curve journey, like it is hard. You know what I mean? Like, because you got to build the thing, you got to communicate the thing, people have to buy it, then you have to improve it, then you have to keep doing that virtuous loop up, and it's hard, especially with an infrastructure business when you're early.
Yeah. What has worked in terms of going out there talking to customers? Like, what have you learned about talking to people? You've been talking to people your entire career, but what have you learned from your entrepreneurship journey about selling into people?
So I learned a lot. you know, I might not present this way, but it's been really humbling. I learned there are certain things that um, I had to get flexible on, and um, I had to internalize, and it was largely around product